Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
We've got three major stories for you today. First, we're diving into Perplexity AI's shocking $34.5 billion bid for Google Chrome, a bold move that comes just as the US Justice Department is pushing for a sale. Then, we'll unpack why Wall Street is cheering for a Federal Reserve rate cut even as core inflation unexpectedly jumped, with one economist warning the real peak is still months away. And finally, we'll examine Rolls-Royce's audacious plan to power the AI boom with miniature nuclear reactors, all while launching an assault on the $1.6 trillion jet engine market. An AI startup just made a stunning $34.5 billion bid to buy Google Chrome. That's right. Perplexity AI, a company valued at just $14 billion, has made an all-cash offer to acquire one of the most critical assets of tech giant Alphabet. This isn't just a bold move, it's a strategic strike in the heart of the AI wars. Now, what many might not remember is that this isn't Perplexity's first rodeo with massive, high-profile bids. The company previously made a $50 billion offer to acquire TikTok. This pattern suggests their grand strategy isn't just about building better AI models, but about aggressively acquiring massive pre-built distribution channels. While the company claims it has full financing from unnamed funds, the bid's timing and the lack of disclosed backers raise a critical question. Is this a serious acquisition or a brilliant public relations maneuver to elevate its brand in a crowded market? This is where the situation takes a more complex turn. The offer lands while Google is already under immense pressure from the US Justice Department, which is seeking to force the company to sell Chrome due to an antitrust ruling. Forcing a sale, you see, is a high-risk move, even if it's intended to increase competition. History shows these kinds of antitrust remedies can have unintended consequences. When AT&T was broken up, for example, the legendary Bell Labs went into decline. Handing a critical piece of internet infrastructure like Chrome to a smaller, less resource company could potentially jeopardize its stability and innovation, affecting billions of users worldwide. Perplexity isn't the only one circling. Reports show that OpenAI and Yahoo have also expressed interest, turning this into a high-stakes bidding war for the web's most valuable real estate. The prize isn't just a browser, it's the gateway to over 3 billion users and the prize data that fuels the next generation of artificial intelligence. From a technical standpoint, an AI native company like Perplexity doesn't just want a browser, it wants to fundamentally re-architect it. The goal is to transform the browser from a simple information tool into a proactive AI agent that can execute complex tasks for you, like booking travel or even writing code. But this comes with huge challenges. Research shows that running these powerful AI models inside a browser can be incredibly slow and demand enormous amounts of memory, and there are major privacy risks in giving an AI that much access to your digital life. Perplexity claims it has full financing for the deal and has pledged to invest $3 billion into Chrome over 2 years, all while keeping its core code open source. Now, that open source part is particularly interesting. Chrome is built on an open source project called Chromium, which also powers browsers like Microsoft Edge and Opera. However, Google is the primary steward of that project, contributing an estimated 94% of the code and hundreds of millions of dollars in maintenance. A change in ownership would fundamentally shift the governance of this foundational web technology, raising questions about who would truly control the future of the web. But that's not the whole picture. While Perplexity's $34 billion offer seems massive, some analysts believe it's a low-ball bid. The CEO of rival search engine DuckDuckGo has suggested that if Google were forced to sell, Chrome could command a price tag of at least $50 billion. Google hasn't offered Chrome for sale and is expected to fight any forced divestiture with a lengthy legal battle that could reach the Supreme Court. But the offer is on the table, a public challenge has been made, and the AI industry is holding its breath. The battle for the gateway to the internet has officially begun. All right, shifting from tech behemoths to the economy, we're seeing a fascinating contradiction play out. A key inflation number just hit its highest level in 6 months, even as markets are betting the house on an interest rate cut from the Federal Reserve. Wall Street took today's headline inflation report as a green light, sending stocks ticking up on the belief that a September rate cut is now locked in, and the speed of that reaction tells a story in itself. It's not just human traders. We're talking about sophisticated trading algorithms that process this news in microseconds. They use advanced language models to scan for keywords and analyze the sentiment of the report, executing trades faster than any human ever could. That's why the market moves so quickly on this stuff. The data seems to show inflation moving closer to the Fed's target, with one analyst even predicting a 50 basis point cut by the end of the year. The Fed's decision-making process, however, is famously data dependent, and that means they're looking at way more than just this one headline number. To get a faster, more granular read on the economy, central banks are now using high-frequency alternative data. Think real-time credit card transactions, mobility data, even satellite imagery of commercial activity. For example, the Federal Reserve Bank of New York has a weekly economic index that pulls in all this high-frequency data to monitor the economy in near real time, giving them a much richer picture than the official reports that have a time lag. However, if you zoom out from that headline number, you'll see another layer of strategy at play. Beneath the surface, the so-called core inflation rate, which strips out volatile food and energy, just jumped to 3.1% year on year, its biggest gain since January. The reason? Rising costs from import tariffs are finally starting to show up. One chief US economist at PGIM is sounding an even louder alarm, stating, quote, "The real peak inflation is not today. Peak inflation on the back of tariffs is actually months from now." He warns that companies have been using their inventories to absorb the costs, but that buffer is running out. So the thing is, how these companies have been absorbing the costs is a story in itself. It's not just about having extra stuff in a warehouse. We're talking about a high-tech tariff absorption stack. Companies are using AI-powered software to predict demand and optimize their supply chains. They're using real-time logistics platforms to dynamically reroute shipments away from problem areas. Research from McKinsey shows that firms doing this can cut logistics costs by 15% and improve inventory levels by 35%. They've been using this technology as a shield, but that shield is starting to crack. This creates a massive potential conflict for the Fed. A chief global strategist at Principal Asset Management notes that because of this, inflationary pressures are likely to pick up just as the Fed starts to resume rate cuts. So while the market celebrates a potential cut, the real drama is just getting started. The question is no longer just about September. It's whether the Fed is about to start cutting rates, right, as the real inflation bomb is set to go off, with one strategist warning the entire market narrative could, quote, shift directions several times over the coming months. Speaking of high-stakes gambles with massive economic implications, let's turn to Rolls-Royce. The company, famous for jet engines, just made a stunning claim. Its new mission is to power the artificial intelligence boom with miniature nuclear reactors. The CEO is so confident he believes this plan could make Rolls-Royce the most valuable company in the entire United Kingdom. The context here is crucial. The AI models we're all hearing about require an astonishing amount of electricity to train and operate. We're talking about data centers that consume as much power as entire cities, and that demand is expected to skyrocket. Just 2 years ago, the new chief executive described the company as a burning platform. Today, its share price is up over 1,000%. So what's the play? It's called small modular reactors, or SMRs. Actually, taking a compact, powerful reactor from a submarine and putting it on land isn't a simple copy-paste job. They have to pass an incredibly rigorous safety and design review by the UK government, a multi-year process called the Generic Design Assessment. They are literally proving they can scale up the power and make it safe enough to operate near our infrastructure. This is a massive engineering and regulatory mountain to climb. Rolls-Royce, which already builds reactors for nuclear submarines, wants to bring that technology on land to power energy-hungry AI data centers. Interestingly enough, while these reactors are low carbon, they're not impact-free. We're talking about a potential green AI paradox. Both the nuclear reactor and the data center it's powering need colossal amounts of water for cooling. Research suggests a single SMR could use hundreds of millions of gallons of water every single day. This creates a whole new set of environmental challenges. The CEO predicts $1 trillion market for these reactors and declared, "If we are not market leader globally, we did something wrong. This isn't just a business competition, it's a geopolitical one." The US, Russia, and China are all racing to develop their own SMRs. The country that masters this technology could become a primary energy gatekeeper for the entire global AI industry, shifting the balance of power for decades to come. And if that wasn't enough, while betting the farm on unproven nuclear tech, the company is also launching an assault on a second, even bigger market, narrow-body aircraft engines. This is a $1.6 trillion prize, completely dominated by powerful incumbents. This decision brings both immense opportunity and comes with inherent risks. A major rival, Pratt & Whitney, already tried to break into this exact market and lost $8 billion in the process. Industry veterans warn that market leaders will slash prices to crush any new challenger. This all begs the question, is this a historic turnaround story with a company rocketing from a burning platform to dominate two of the world's most critical future industries? Or is it a high-stakes gamble on two fronts, where failure could be catastrophic? One thing is certain, the market is watching every single move.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.